Welcome to the KMG Fiduciary Partners Podcast. Here, we'll cover important topics on financial planning and asset management to help keep you informed and inspired for long-term success on your financial journey. Let's join the KMG team now for today's topic. Welcome to the KMG Fiduciary Partners Podcast. My name is Cameron Kaiser, and I'm a wealth advisor and CFP professional here at KMG. I'm here with Rob Thompson, who's a CPA and also a wealth advisor here at KMG. So Rob, you being a CPA, I want to ask you a very important question. What's the difference between tax preparation and tax planning?
So I get that question all the time, right? It's do you do tax returns?
Mm-hmm.
And my answer is no for a few reasons, but number one is the true value is doing the planning far before any sort of tax forms, tax documents are released from whatever company, whether it's you receiving your W-2s or anything like that. It's mapping out and projecting out where income is going to land along the ways that is going to allow us to make sure that we're maximizing any available vehicles that are out there, whether
Mm-hmm.
it's ensuring we're taking care of maxing our HSA out, which is always to me a no-brainer, right? Or looking at things like, did I make too much money to contribute directly to a Roth IRA? Do I need to do a backdoor Roth IRA contribution, right? And ensuring that you do these things in a timely fashion, but also within the restrictions that are set forth in the tax code, it's important to know really where income is going to land, right? Before we make any sort of moves like this. Because the last thing that you want to do is over-contribute to things like your health savings account or Roth for that matter. Because getting it out of those accounts or backing out that excess contribution is not the prettiest or smoothest process.
Sure. So would you say that, again, everyone's probably a little different, but at the beginning of the year, roughly, that's when you kind of have a general idea of what you want to contribute to for the rest of the year, and then towards the end of the year, you do one last final check before the year comes to an end to make sure there's no surprises, to make sure withholdings are in line, to make sure that income is where you thought it was going to be, and if it's not, what you need to do differently before the year comes to a close.
No question. So at the beginning of the year, typically what I'm doing at that point is, number one, just checking to see if withholding looks good, right? Mm-hmm. For one reason or another, there may have been a life-changing event. A lot of the times what happens actually, especially in my world right now, everybody's getting married, right? Just at that stage. And if both spouses, both newlyweds, were making good money individually and kind of on their own, when they combine incomes for the first time ever, and according to the IRS, you're married, whatever your marriage status is on the last day of the calendar year is how you will file your tax return, mm-hmm. right? So if there's two individuals that get married, they're making good money, more often than not, withholding is going to be skewed and they're going to owe a pretty good chunk of money when they go to file their tax return, and it catches a lot of people off guard. So getting in there, making sure withholdings check out is important, obviously. But it's a bunch of other things. Obviously, for W-2 employees, there's only so much that we can do. We want to make sure that we're maximizing the benefits that are either provided through their employer plan or anything outside of that they're eligible to maybe contribute to or take advantage of, for starters. Number two is upon retirement, when you're no longer in that wealth accumulation phase, but rather the distribution phase and we're sending you money out, understanding where you're going to land is a very important aspect of how we're going to send money to you in a tax efficient manner, right? And determining liquidity of funds, where things are at. Do we pull more money forward out of the IRA this year, knowing we've got large required minimum distributions in the future, right?
Sure.
Or it can even get as far as down the line, right? We want to make sure we check the box and we've determined that you are not going to run yourself out of money. So now the conversation shifts from how do we pass along the wealth that we've built up and accumulated throughout our lifetimes to the kids in a mm-hmm. tax efficient manner, right?
Sure.
So that's when looking at things like Roth conversions come into play, but also it can be even more immediate from a gratification standpoint, at least, in just talking about, hey, maybe rather than waiting until we pass away, we help the kids out now while they're just getting started in their careers or whatever the case might be. So, because maybe it's not going to change their lives when they inherit $1 million at 60.
Sure.
But today, $10,000 to help with the down payment of a house might go a long way, mm-hmm. right? So it's looking at all these things and making sure that we're checking all the boxes that we want or need to on an annual basis. It's little things and little moves here and there that over the long haul make up a huge difference.
Absolutely.
So back to your initial question on the tax planning or tax prep. Tax preparation is typically the final result of tax planning, right? By the time that you are going to file your tax return, you're already prohibited from making most adjustments or moves that are going to have any impact on your taxable income, with the exception of making some contributions to specific accounts like Roth or HSA. But otherwise, the true value to us in our eyes is proactive planning, and by the time you get to the tax return, anything done there is reactive, right? And in this world, in the tax code that we live in, being proactive is the most important thing.
Yeah, absolutely. I think that's well put, and I think that everyone's going to be a little different, like almost everything that we talk about. So it's important to try to strategize this before April 15th. Well before then, sit down with one of us or an advisor here at KMG and try to figure out a long-term plan so you're not paying more tax than you have to, and just making sure that you're taking advantage of every single strategy that applies to you.
Yep.
Thanks for joining us for this edition of the KMG Fiduciary Partners podcast. We invite you to catch the next episode in our series for real-world advice from the KMG team. Follow us on LinkedIn at KMG Fiduciary Partners, where we'll keep the conversation going.